Hi, this is Rob Aspen. Wanted to give you a quick heads up of the action that we saw yesterday, show you a couple of charts and give you an idea of where we think the market is going to be going. We saw quite a significant correction yesterday across most of the markets, with the index being down 3.75% in the US for the S&P. Dow was down 4.15%. The Nasdaq down as well. So we've now effectively had a fairly significant sell-off, which would be classified very much as a correction. We've got a little bit further to go before the market tests its 200-day moving average. And from a technical aspect, we would envisage that this should prove to be a resistance level. If the market falls below this level, we would be somewhat concerned. You can see in prior periods, for example, if you look at October period around 2015, one of the factors that we believe is driving that is due to the fact that the bond yields have increased. So I've highlighted a chart here showing the 20-year US Treasury yield. You can see that it's spiked significantly higher in the last couple of weeks. It's now 3.03. And has effectively broken through the trend line. So this is indicating is that the market is increasingly concerned about longer-term inflation, and this is actually now in conjunction also with the fact that QE policies are being withdrawn. So effectively, the Fed is buying less securities, and indeed at this point in time is actually looking to offload some of these securities. So a natural fallout of this is the fact that yields will be expected to ramp up. So you have higher inflation causing concern on the one hand. On the other hand, you have QE policies being pulled back. That creates the perfect storm: higher yields, higher cost of borrow, which causes then implications for the stock market, as we've well seen. One of the key implications of all of this is that the risk parity funds, and they control around $2 trillion worth of assets globally, will come under pressure, because typically what they tend to do is look for assets which have a negative correlation to one another. So for example, they'd hold bonds, they'd hold equity. As the one performs very well, the other tends to underperform, and vice versa. Now what we're seeing actually is both asset classes underperforming quite significantly. So they'll effectively have to pare back risk. Some of these managers will be leveraged, so we're going to see more of these positions falling through, which could push the market a little lower given the sell-off that we've already seen to date. So technicals are quite important, and what happens to yield in the VIX is obviously quite important as well. Take care and have a great weekend ahead.